Okay, so we custom designed this analysis specific to your age and a little bit that we know about your current financial situation. We'll obviously need to verify your current financial situation with tax returns, your balance sheet, and a few other financial documents. But for now, we'll review a few concepts based on what your advisor told us. Now, if you've ever applied for life insurance before, then you know that we won't know the exact numbers until we submit an application to the insurance company along with a paramed exam. That's the blood and urine test to have you go through full formal underwriting. But the numbers in this video will give you a range of potential outcomes, based on what we know about your current situation so far. My firm, Landsmark Capital, is a data analytics firm that specializes in the estate planning industry. Our educationally based platform helps both clients and advisors better understand how different estate planning solutions perform in different types of market conditions. And although this may sound like overkill, we actually analyze 121 different actual historical 40-year periods of market performance. And then we analyze the merits of several different types of real world products, including equities, bonds, and life insurance. Now, when it comes to life insurance, there's basically three different types of people. And chances are you probably fit into one of these three categories, which is why you're watching this video right now. So, the first type of person that buys life insurance is someone that wants to basically ensure that their family has enough money to pay the bills if they died unexpectedly early and their family no longer had their income to live on. The second type of person that buys life insurance is someone that wants to provide their adult kids with enough money to pay the estate taxes when they inherit their estate. Typically, these types of clients have a net worth well above $25 million. And the third type of person, they look at life insurance as a separate liquid asset class, kind of like a tax free sinking fund that they can use to fund their future needs, whether they be trust expenses or they want to create a tax free retirement income stream. Now, in some cases, you can actually finance the premiums, kind of like buying real estate with a mortgage loan, leveraging a bank's capital to purchase a valuable asset. So, in this video, my job is to transparently and objectively compare a range of outcomes that different types of estate planning assets could produce in several different market conditions. Again, 121 different actual historical 40-year periods of market performance. So, let's take a look at your specific situation and we can explore your options. So, today we're going to introduce a concept to you called premium financing, which uses lender capital to finance your life insurance premiums. And now, this may seem like a new concept to you. However, it's not all that different than how you've probably purchased other valuable assets in the past. Maybe you financed your college tuition using student loans, or purchased real estate using a mortgage loan, or expanded a business using a business loan or a line of credit. Well, because you have a substantial net worth, the life insurance companies allow you to purchase your life insurance policy using a similar method, leveraging a bank's capital to fund your life insurance premiums. So, in this particular method of premium financing, called first dollar financing, the lender pays 100% of the premiums for you, and in each year, you'd pay the lender interest only payments on the principal loan balance. And now, inside the life insurance policy is an interest bearing account that grows tax free. They call this cash value. And at some point, that account's appreciated value can be used to pay off the third party lender, at which time there would be no further interest payments due, obviously because the loan is paid off. And you could start taking tax free income drawdowns from the policy and still have a life insurance policy that's designed to stay in force until end of life, at which point the death benefit would pay out tax free. So let's take a look at the ledger so you can see the actual numbers in your specific design that we designed for you based on the assumptions that we made about your age, your health, your financial situation, and a few other factors. Again, we won't know your exact numbers until we go through full underwriting with the insurance carrier, which obviously hasn't happened yet. But I would highly recommend that we do submit an application to the insurance carrier to apply for coverage to find out what your exact health rating and your exact numbers would be. So, before we dig into the details of your options, this summary page shows two different types of hypothetical assets. Now, our backtesting platform literally analyzes 121 different actual historical 40-year periods, and we tag the 40-year period that produced the best compounded annual growth rate, as well as the 40-year period that produced the worst compounded annual growth rate. Later in this video, I'll explain exactly how we do our backtested modeling, but just to give you a summary snapshot of what we found regarding your particular situation, in the top section, the bar graphs show the total retirement income drawdown. The line graphs in the bottom sections show the ongoing account balances. Now, on the left side of the screen shows the outcomes during the best 40-year period that we analyzed, and on the right side of the screen shows the worst 40-year period that we analyzed. The green represents the financed option, which we're going to discuss in great depth in just a moment. And the blue line represents the non-financed traditional investment. Now, in this video, I'll transparently review the details of how these outcomes came to be, but remember, this is only a summary video. We highly recommend that you have several in-depth conversations with your trusted advisor to explain each component in greater detail. And I'd also highly encourage you to include me in those conversations as well. Okay, so let's go ahead and get into the details of how premium financing might work in your specific situation. Okay, so I know this is a lot of information to digest at once, but I promise I'll make this easy to understand. And again, you'll receive copies of everything that we're going to review, plus the full official carrier illustration. And just a heads up, depending on how large or small your computer screen is, if the numbers in this video are too small, legibility-wise, please ask your advisor for a PDF copy of the full analysis that we're reviewing in this video. We've already provided them with a copy. And you can blow up the PDF to a bigger size and reference the pages that we'll be reviewing in this video. Or you could obviously print out all the pages as well. Okay, so yellow arrow number 1 shows the premiums borrowed from the lender. You don't pay those premiums. Well, you could if you wanted to, I suppose. But in this particular premium financing arrangement, the bank would be paying those premiums for you. And yellow arrow number 2 shows you the interest-only payments that you would make to the bank each year, which is the interest on the cumulative borrowed premium on the loan balance. So you see the interest payments are increasing each year, and this happens for two reasons. One is that you're borrowing more premium each year, which is what we see in the red box there by yellow arrow number 1. And so the interest that you'd pay is on the increasing total loan balance each year. And then the second reason in this depiction, it shows the interest payments increasing, is that we have the bank's borrowing rate artificially increasing each year under the assumption that borrowing rates are going to increase each year, which may or may not happen. Borrowing rates may increase in the future. They may also decrease in the future. But for the sake of this hypothetical depiction here, we're showing them increase every year, again, just to be conservative. And we'd obviously have to see what loan rates we could get you qualified for from the various lenders that we work with. We work with multiple banks, multiple lenders, so we'll shop to get you the best rates and the best loan terms available. Again, the rates could be higher or they could be lower than what we're looking at on the screen here. This just gives you a ballpark. Now, in the early stages of the policy, yellow arrow number 3 shows you the estimated amount of outside collateral that you would have to post. And in the bottom box there, it shows the type of collateral assumption that we're using in this particular depiction. But in theory, you could also use a CD, a letter of credit, marketable securities, and in some cases, you could even use real estate equity as collateral. Now, if the collateral is cash or bonds, most lenders will credit 95 to 100% of the value towards the collateral requirement. And if you post marketable securities, they'll usually discount that value by 25 to 50% because if the market crashes and your securities lose 20 to 50% in value, the lender wants to make sure the collateral still covers the shortfall. Now, in some cases, you might even be able to use real estate equity as collateral, which is very unique in premium financing. And we can talk about that offline if you like. If the policy cash value grows to a greater value than the outstanding loan balance, the policy would then become the sole collateral on the loan. And obviously, once the loan is paid off, any outstanding collateral that you posted would be released back to you. And yellow arrow number 4 shows you when the policy cash value is expected to pay off the bank loan. And even after we do that, yellow arrow number 5 shows the tax-free income drawdowns that you receive, based on these certain assumptions in this particular ledger. And yellow arrow number 6 shows the ongoing net death benefit that would pay out even after you take all of those income drawdowns. Now, these assumptions include a certain level of performance of the interest-bearing account inside your policy, and we'll discuss how this account's crediting method works in just a few minutes here. Okay, regarding the interest-bearing account inside the life insurance policy that I mentioned earlier, by the way, this is the same ledger we initially looked at. These numbers, both the cash value and the death benefit, are based on the assumption that this interest-bearing account produces this static positive credit every year, year after year. Now, the way this assumption was created is based on what the life insurance regulators say is a reasonable expectation. And the way they determine what a reasonable expectation is they take the average of every 25-year rolling period over the last 65 years. Well, there's one thing we know, and that's that the market is never going to produce this positive static return every single year. Right? In some years, the market's going to produce a return much higher than this, and in other years, the market's going to produce a return much lower than this. And I'm not a fan of using static average returns because average returns can lead you to believe something that, in my opinion, can be very misleading. As an example, if you got a 50% return in year one, and in year two you lost 50%, it's a mathematical truthful statement to say that the average return was zero. However, if you had a $100 account balance and you got a 50% return in year one, your account balance would be worth $150 at year end. If in year two you lost 50% of your $150 account value, your account balance would be worth $75 at the end of year two. So even though the average return was zero, you would have actually lost 25%. You see how misleading that is? That's why we built our backtesting model that we're about to review with you right now. So let's take a look. So what we've done is created a proprietary software application that models 121 different historical 40-year periods that actually happened. And we've created a proxy for your policy, which we call a leveraged hypothetical synthetic proxy, to show you how charges and crediting methods, similar to the real world product, could affect outcomes over different times of volatility. Even more importantly, during a poor sequence of returns. So this is our method of stress testing the design. So here's what our software actually does. We start off with this 40-year sequence with a starting point on January 1st, and then we roll forward 40 consecutive years from that point up until an end point 40 years later on December 31st. Now, during this 40-year historical period, here's the compounded annual growth rate the S&P 500 produced during that 40-year window. But then we said, what if the client had just started 1 month later in the same year, say on February 1st? Roll forward 40 years, and that would put an end point at January 31st, 40 years later. Then we repeated this process all the way up until very recently, which produced 121 different historical 40-year periods that we analyzed. We tagged the period that produced the best compounded annual growth rate out of those 121 different 40-year periods analyzed, and we also tagged the period that produced the worst compounded annual growth rate out of those 121 different periods we analyzed. I like to focus on the worst 40-year period because I think that's a reasonable thing to focus on, in the spirit of conservatism. Now, to be clear, even though this is the period that produced the worst compounded annual growth rate out of those 121 different periods we analyzed, it is possible that the next 40 years could produce an even worse outcome than this 40-year period. Just like it's possible, in theory, that the next 40 years could produce an even better outcome than the best 40-year period we analyzed. So this is not the worst possible outcome that could ever exist in the future. This is just the worst one out of those 121 different 40-year periods that we analyzed. Now, to be clear, this proxy we're going to look at is not a life insurance illustration. This is a proxy created to help you better understand how the charges and the crediting methodology works in some products. So, to use an analogy, if we were scientists and we wanted to study the behavior of the sun, for example, like the electromagnetic fields around the sun, the solar wind around the sun, things like that, it would be impossible to take a rocket ship up to the sun, land on the sun, scoop up a little sample in a Ziploc baggie, and bring it back to the Earth and study it in the laboratory. But we could build a proxy for the sun in the laboratory, like a super hot plasma blob, and study the behavior of that in order to gain a better understanding of the sun's behavior. They actually did this at the University of Wisconsin-Madison. They called it the Big Red Ball, which was essentially a recreation of solar plasma that they used to study the behavior of the sun's electromagnetic fields. Essentially, they built a proxy for the sun. Well, that's what we did with this life insurance policy design. We created a proxy for the premium finance life insurance policy in our laboratory, and we call this, again, the leveraged hypothetical synthetic proxy. And the spirit of creating this was really rooted in education and our desire to help you better understand how the charges and crediting methodology works relative to the borrowing rate, instead of just showing a static positive credit every year. Now, in this video, we're going to take a look at a very specific historical period, starting off with the worst decade in recent history, which was the years 2000 through 2009, that started off with 3 negative S&P 500 returns. That was the tech bubble in the years 2000, 2001, and 2002, and then, of course, the mortgage crisis in 2007, 2008. Now, the reason we're going to start off with this sequence is that we want to see how this type of poor performance would have affected the premium financing proposition over time. Then we're going to continue this sequence all the way up until the end of 2021, and we're also going to look at what borrowing rates would have been during these same back-tested years to analyze the symbiotic historical relationship between borrowing rates and crediting rates. Because, one of the biggest mistakes a lot of people make is that they only look at the borrowing rates in isolation, when in reality, what makes a premium financing arrangement work long term is the potential positive arbitrage between the cost of borrowing versus the cash value gain. So here's a 40-year window that starts off with the sequence of returns I was referring to earlier, the years 2000 through 2021. That's years 1 through 22 in this particular 40-year sequence. And then from there on out, we're showing a static return each year that's equal to the average of every 25-year window over the last 65 years, specifically based on this particular real-world product's design. Then we apply the real-world's product floor, cap, and any bonuses that this specific product might have, which produces what we call the effective index credit. In other words, what the actual index credit would have been in each year based on the floor, the cap, and the bonus. And then we also show what the historical borrowing rates would have been during the same back-tested period. Because, again, it's not just the borrowing rate in isolation that you should be looking at when it comes to premium financing. It's really the borrowing rate versus the crediting rates and how those two different statistics affect outcomes over time. But there's one important thing to understand when it comes to how the crediting method actually works. Before the annual credit, the charges are deducted. In this proxy model during the 40-year period that produced the worst compound annual growth rate, out of the 121 different periods we analyzed, we deduct standard charges at the beginning of each year. These charge amounts were taken directly out of the carrier illustration we ran, which include cost of insurance and all the other charges and fees that exist in the carrier illustration we ran. Now, in a real life insurance policy, these charges may be a little different based on the health rating you eventually get approved at after you go through full underwriting with the carrier, as well as how the interest bearing account actually performs in real life. But for the sake of this hypothetical proxy, we'll assume these charges are static. Now, from a crediting standpoint, the account is based on the performance of a particular index, like the S&P 500, for example, and it has a cap and a floor. So the floor is the minimum allowable return in a given year, kind of like a stop loss feature. And the cap is the maximum allowable return in a given year. So if the index produces a positive return, you would get that index credit up to the cap. And in a year wherein the index produces a negative return, you would be protected by the floor. Now, in some cases, you may qualify to opt in for additional asset-based charges in exchange for a multiplier bonus. Not all products have this option, so we'll have to discuss this in greater detail before you make any decisions. But here's how this option works. If you select this feature, after the floor and cap have been applied, the annual credit is multiplied by the multiplier factor, creating the effective annual credit, which is a percentage of the gain that your account would receive in that given year. So in a year where you receive a positive return, the multiplier bonus really supercharges that return, giving a much higher effective annual credit. Again, in some products, they have this feature, and some products they don't have this feature. But the ones that do, you can elect to turn it on or off at the beginning of any given year at policy anniversary. Now, the downside of this feature is that in a year wherein the market produces a negative return and you get a 0% annual credit, for example, 0 multiplied by this multiplier factor is still 0. But you would still incur the additional asset-based charge. So in a year where you get, say, a 0% index credit, that doesn't mean you don't lose any account value, because although you didn't get a negative return, the charges would still decrease your account value in a year wherein you received a 0% annual credit, for example. So the question is, after all the charges, is this still a product worth financing in this arrangement that we've been talking about? Well, let's find out based on your specific numbers that we modeled and analyzed. So this is why this backtesting report is so valuable. We showcase this synthetic proxy depiction during the best and worst 40-year periods analyzed, with all the charges deducted and the credits with any bonuses that may exist. And we compare it to a depiction using the static return assumption shown in the carrier illustration. So the data in this graph shows the simulated account values of our proxy during the period that produced the best compound annual growth rate out of the 121 different historical periods analyzed, right there in the heavily dashed green line. It also shows the simulated account values of our proxy during the period that produced the worst compound annual growth rate out of those 121 different historical periods analyzed in the dotted green line there, versus the account values assuming a static return as depicted in the carrier illustration, right there in the blue line. Now, what's also interesting to point out is that the black line there uses the same data as depicted in the carrier's illustration's death benefit, based on that static return assumption that we see there at the bottom of the page. Now, if the actual cash values in a real world life insurance policy were equal to these green dashed or dotted lines, and they eclipsed the black line in this graph, the actual death benefit would automatically be pushed up because in a real world life insurance policy, the death benefit must always be higher than the cash value at any given time. And it's important to note that both the outcomes in the hypothetical synthetic proxies and the numbers in the carrier illustration, are all hypothetical depictions. Right? I mean, no one knows what the future performance of the market is going to look like, so none of these hypothetical depictions are guaranteed. But the spirit of what we're showing you here is rooted in transparency and in really client education, so you can better understand the crediting method and assumptions made that produce this range of hypothetical outcomes. Again, this video is purely for educational purposes to briefly explain these hypothetical models. The slides in this video are just a few slides taken out of the entire report. So, for a full description and detailed overview, a full report will be made available to you for your review. And lastly, for those people that are concerned about us heading into recession, the solid green line depicts the simulated account values in our proxy, assuming the S&P 500 performance from the years 2000 through 2021 during the first 22 years, and then a static average return thereafter in years 23 through 40. Now, during this time, there would have been 0% index credits within the first 10 years of this sequence. And even more importantly, this sequence starts off with 0% returns in the first 3 years. Now, we also tracked borrowing rates during the same backtested period, and we see at the bottom of the screen the total interest paid out of pocket during this time was actually less than what current borrowing rates are depicted at in the first three scenarios. Because, historically speaking, interest rates were lower during that period of time than they are today, despite them being on the high end in the year 2000. And so that's why it's important to understand that in premium financing, we have to analyze the historical borrowing rates compared to the historical crediting rates, to truly understand the relationship between the two. So it's not just the borrowing rate or just the crediting rate assumption that we need to look at. And in this back-tested scenario that starts off with arguably the worst 10-year sequence in the modern economy, we see that premium financing using this particular model works extremely well from a mathematical standpoint. This summary page shows two different types of hypothetical assets. Now, our backtesting platform literally analyzes 121 different actual historical 40-year periods, and we tag the 40-year period that produced the best compounded annual growth rate, as well as the 40-year period that produced the worst compounded annual growth rate. But just to give you a summary snapshot of what we found regarding your particular situation, in the top section, the bar graphs show the total retirement income drawdown. The line graphs in the bottom sections show the ongoing account balances. Now, on the left side of the screen shows the outcomes during the best 40-year period that we analyzed, and on the right side of the screen shows the worst 40-year period that we analyzed. The green represents the financed option, and the blue line represents the non-financed traditional investment. But remember, this is only a summary video. We highly recommend that you have several in-depth conversations with your trusted advisor to explain each component in greater detail. So in summary, again, this video was just to help you better understand how different crediting methods, fees, taxes, and volatility can affect outcomes in the long run. And hopefully this has given you a more mathematically transparent view of what your options really are. So I'm a 9-time author with several of my books being distributed in 14 different countries, plus the US, obviously. And one of them is called Premium Finance Life Insurance, the Key to Effective Estate Tax Planning. It's available on Amazon, but we're also making the ebook version available to you for free. If you go to leveragedindexarbitrage.com, and just scroll down to the bottom of the homepage. It's right here below. You can actually download it for free if you really want to get into the details of everything we just talked about. It's kind of a technical book for math nerds like me, but if you're into that sort of thing, I wanted to make sure that I made it available to you as a resource. Again, I'm going to go ahead and sign off here. And I would highly recommend that we set up a Zoom meeting so we can meet each other virtually face to face, and we can find out if premium finance life insurance is right for you. Look forward to meeting you soon.